Good morning, it's Jeffrey Christian of CPM Group. It's not quite 11:30 on Friday, the 29th of July, last business day of July already. I wanted to talk today about the state of the economy and what it means for precious metals. Not too much to go over, but this week we've seen interest rate increase, which did not have the effect that a lot of people, including CPM Group, expected on commodities and on the stock market. We've seen some pretty high volatility across financial markets as they wrestled with the interest rate increase and other factors, including the first estimate for second quarter GDP. We saw the dollar strengthen further, and then it weakened. It's a little bit weaker today. It's a little bit under pressure. And there's a lot of talk about recession and other things going on. So I wanted to run through some of those factors and then talk a little bit about what it means for gold, silver, platinum, palladium. And then I have some housekeeping at the end. Excuse me on that. The first chart I have is the personal consumption expenditures data, excluding food and energy. That data was released today. It's an alternative measure of inflation in the US, and it's important because it's the one that the Fed thinks is more representative of inflation than, say, the US CPI. Both the US CPI and the PCE have shown some weakening. Inflation rates are still very high, but the rate of increase is declining from what it was a couple months ago. And I think that has some important implications for future Fed policy. The market consensus has been that, having raised interest rates 1% last month, 75 basis points this month, that for the rest of the year, the Fed may well scale back to 25 basis points increases, and then may even flatten out. The gold marketeers keep talking about how the Fed has to pivot and reduce rates. Mainstream economists and other people, mainstream economists and the major consensus in the financial markets is not that the Fed will be lowering interest rates anytime soon, but rather that the pace of increases will taper off over the course of this year. That's taper, not tamper, for the trolls out there, and then probably possibly hold steady. And that has to do with economic conditions that we're seeing, which I'll talk about with the GDP figures in a minute or a second, or something between a minute and a second, and currency rates and expectations for economic trends. So this is the US 3-month Treasury bill rate, and we can see it has risen. It rose again this week, actually in anticipation of a 75 basis point increase in the Fed funds rate. It rose about 75 basis points. It actually weakened a little bit after that. The important thing, which we keep making we keep making about this, is you can see this very sharp increase in T-bill rates and other short-term interest rates and long-term interest rates as the Fed has begun to raise interest rates and suck excess capital out of the economy. And there has been a lot of talk about, well, they can't raise interest rates too much, again, mostly by gold marketeers, and that this is going to throw us into a recession. We may get thrown into a recession. We have had a recession in the first half of this year. From indications with the first estimate of GDP for the second quarter, but it's not going to be the Fed doing that. The important thing, that with all of the increases from 0% to 2.5% in the Fed funds rate and in the Treasury rate, you are still at levels lower than what you saw prior to, say, I think this is 2006. So the Fed has a lot of room to maneuver. You're not going back to, we're not in the 1970s when the Fed funds rates and the T-bill rates were trading between, say, 5% and 14%, and went up on a brief basis in 1980 to 21%. You're not in that kind of interest rate environment. You're in an interest rate environment where interest rates have gone from 0 to 2.5% on the short end. So there is still plenty of scope to have anti-inflationary monetary policy without running too much of a risk that would throw us into a recession. Monetary policy is complicated by fiscal policy and by ongoing constraints in the supply side of the economy, and war and deteriorating international cooperation among governments. But there still is a lot of scope for monetary policy to tighten further. Not sure that the Fed wants to, not sure that the Fed will. We've probably seen the bulk of the increases in interest rates now already in the market. Interest rate increases going forward will probably be much smaller, but they're not the boogeyman that everybody should worry about. I would say boogie person, but most boogeymen are in fact male. Let's talk about GDP. The first estimate of 3 of the second quarter GDP came out, and as many people had expected, it was negative. It was negative 0.9%. The market consensus in the real market, not the gold bugs, but the, I'm sorry, I don't want to trash gold marketeers, the arm wavers. The market consensus ranged from negative 1.6% to 0.8% positive, and it came in 0.9 negative. So pretty much right in the middle there. Again, as in the first quarter, a lot of the weakness has been in business inventories. And those business inventories have been declining. Businesses have not been replenishing their inventories for 2 big reasons. One is interruptions in the supply. They can't get the materials that they need to add to their inventories. But the other one, which is much more important, is that businesses have lightened up on inventories because they're seeing some slowdown in final demand for their goods. Now, final demand for goods, personal consumption, industrial consumption, business equipment purchases all remain positive in the second quarter, from what we can tell with the data that's available at the end of July. So again, much of the weakness that we've seen in the second quarter has been business inventories, which can be quixotic and can flip. But we continue to have problems with longshoremen, both on the East Coast and the West Coast. We continue to have problems with trucks and truck drivers for intracontinental driving and delivery of goods and services. We continue to have labor issues throughout the manufacturing and agricultural and services industries. So there still continue to be constraints. But we are in a recession. 2 quarters, that's a recession. It's possibly going to be a mild recession. I'll talk about this in a second. I want to show you a couple other things first, though. This is the actual level of GDP. And you can see it's been down slightly for the last 2 quarters. You can't quite tell, but that little decline at the end on the right-hand side, that is actually 2 quarters of declines. And you can see declines have been relatively modest in terms of the trillions of dollars in the U.S., that is the U.S. economy, and that we remain very high relative to anything that we've seen prior to 2021. So while you're seeing a 0.9% decline on the first estimate, you have to take it into the context of the fact that the U.S. economy is still big. Now, if you look at what economists call the hypothetical capacity of the U.S. economy, we are off the mark by a significant amount, perhaps 14%. So there's still a lot of capacity to grow. And the US economy has that capacity to do that. But there are all these constraints that we keep hearing about that have kept us from being stronger than we could be or should be. Turning to Treasury yield curve, because again, this is something that people latch onto. When the yield curve between the 2-year and the 10-year bonds is the most common measurement of the Treasury yield curve. When the yield curve turns negative, it means that we're headed to a recession. Well, let's look at that, because in the 1970s and the 1980s and the 1990s and the 2000s, you can see, yes, we did see yield curves going negative before recessions. The shaded areas are recessions. And if you look at it for 1/10 of a second, you'll realize, and you can measure this, it was 2 years before a recession in the 70s and 2 years before a recession in the 80s, and about 1.5 years in the 90s, and about 1.5 years in the aughties. So the yield curve is showing price weakness, economic weakness, economic maturity in the expansion. And yes, it has, prior to 2008, often presaged recessionary economic conditions by 2 years. And those 2 years are 2 important years, because it takes us from 2022 to an election year in the United States, 2024. You can see that the yield curve came very low in 2018, and you may remember gold bugs were waving their arms hysterically, saying we're on the verge of a recession. We went into a recession, very brief, in 2020, not because of economic conditions, but because governments around the world engineered that recession. That was a unique recession. It wasn't caused by economic trends. It was engineered by governments in response to the pandemic. It was very brief, and we came roaring out of that economically. The yield curve went back up, steepened again, and now we have gone negative again in 2022. So if the past is precedent, maybe by 2024 we'll have a recession. But as I've said in earlier videos, if you look at the relationship between interest rates and economic activity, they changed dramatically, radically, fundamentally after the global financial crisis and the Great Recession of 2007 to 2009, and the global financial crisis of 2008 to 2011. So the relationship between the yield curve and economic activity ain't what it used to be. But even if it is, it could be another 2 years before you see a recession. And that's cute, and it's funny, especially when you consider all the trolls that hassle CPM Group, because we've been saying for some time that we thought there could be a recession sometime in 2024, 2026. And we're still saying that. We have these are our global GDP projections. The orange line is the world. The top blue line, dark blue line, is emerging and developing economies, which tend to grow faster than advanced economies, more mature economies. And the blue line at the bottom are the advanced economies. And it doesn't really show up here, the recession that we've seen in the first half of this year, because on a full year, these are full year data. And on a full year basis, we do not project that the United States, the advanced economies, or the world will be in a recession on a full year basis in 2022. So in other words, we're expecting stronger economic activity in the second half of the year, which is something we've said over and over again. You can see that big spike up in 2021. You can see that the line's coming down in 2022. We are seeing much weaker growth around the world. And you can see that we don't have a recession until 2024, 2025. And that recession is a pretty big one. Back here at 1990, 1991, and 2000, 2001. In both years, we, in both 1991 and in 2001, we had recessions. They were among the shortest, shallowest recessions in US history. And that's sort of what we're seeing right now. You can see back, this only goes back to 1980, but there was a double dip recession in 1980 through 1983. There was a short recession in 1980. We came out of that, and then we went back to another recession in 81, 82, which was bigger, deeper, and contributed to an international sovereign debt crisis that Nicholas Brady was the Secretary of the Treasury under Ronald Reagan, and Brady bonds fixed that, and Paul Volcker fixed the economy. So we're looking at weakness in 2022, somewhat better economic conditions in the second half of 22 than we've seen in the first half of 2022, and that big storm is still on the horizon. So that's the way we're looking at the world. Now, what's it mean for precious metals? And I apologize, I haven't updated these charts. Silver, gold this morning. Yesterday we issued a trade recommendation. We said, hey, we thought that gold prices would probably fall this week for a variety of reasons, and they didn't. They rose from about $1,690, $1,696 to $1,780. Yesterday we had issued a mea culpa trade recommendation. We said, hey, prices about $1,730, $1,710, I think at the time. We said we thought, or it could go to $1,780. The price was about $1,730, I think, at the time we issued it. The price got to $1,780 today. Silver, got down well below $19. We said we thought it could go to $20 as we reversed our view and said, okay, there's strength, and it touched $20 today. Going back to gold, our expectation for gold and silver is that they remain vulnerable to downside weakness in the short term. We have been expecting them to move pretty much sideways with a slight upward tilt over the second half of this year and into 2023, with the idea that July and August would see weak prices. July definitely saw weak prices. We've seen some strengthening in the last 2 days since the interest rate increase and the GDP figures came out. But we do think that they remain vulnerable to some falling back in August. So this afternoon, we'll probably issue trade recommendations for gold and silver, saying if you're a very short-term trader, we got to 1780, you might want to take some profits. I'm not sure if we're going to suggest going short, but we may just say, why don't you stand aside and wait, see if the prices back off a little bit. I do want to back up and say one thing. The GDP figure, as I said earlier, is the first of 3 estimates. And there tend to be sometimes very large revisions between the first and the second and the third estimates of quarterly GDP. We expect revisions, but we don't expect them to be so large as to cause second quarter GDP to be positive. It's possible at 0.9% contraction. That could disappear, but we do think that from a statistical perspective, we will remain negative GDP in the second quarter, even when the third and final estimate of second quarter GDP comes out. That we think will continue to sort of underpin that. Turning to platinum and palladium have been very hard hit. They've been hard hit by weakness in the auto industry, sales and production and sales, and that represents a combination of factors. We released our Platinum Group Metals Yearbook this week, and it discusses the short-term auto industry changes and the longer-term auto industry changes and their effects on platinum, palladium, and rhodium. You have ongoing supply and production constraints in the auto industry. In addition to that, you have lower growth and more hostile economic conditions, so people are buying fewer vehicles around the world. You're also seeing growth in the electric vehicle industry, which is supplanting some of the demand for PGMs in auto cats that are used in cars that burn petroleum products for their propulsion technology. So you are seeing the auto industry and the auto industry's use of PGMs come under some pressures, and those pressures probably will continue for some time to come. In addition to that, we've been seeing a substitution away from palladium to platinum. And for most of this year that we estimated about 100,000 ounces might have been substituted last year. It would have been larger, but for the fact that the auto industry's production figures all fell because of supply constraints and demand constraints, but mostly supply constraints. And it's probably about a 200,000 ounce shift away from palladium to platinum this year. We've heard somebody else use similar estimates. I assume they made the same calculations. They talked to the same people that we do. I don't assume that they were just listening to us and repeating what we've said. They're not our clients, but they have been in the past, and they have been known to listen to us from a distance. But we are seeing that substitution away from palladium to platinum. And the platinum and palladium markets have been hit by weakness in the auto industry, which is the major use of them. They've also been hit by investors looking at the auto demand trends and saying, okay, this is not particularly bullish for platinum and palladium. So there have been some factors that have constrained them. Last year, we saw platinum prices traded between $800 and $1,000 for most of the time from late 2015 until last year. And we have been saying for a couple of years that we thought that the platinum price would break out of that range and move into a higher range above $1,000, and then ultimately could make a spike higher at some point in the ensuing part of this decade. Last year we saw platinum break above $1,000. It went up to about 13 something. It has come back out and it's down below 900 now. So it's back into that $800,000 range. We've seen the potential for platinum to break out, and we assume that that potential will be realized at some point when the economic environment is more supportive of auto production and sales. They are losing market share to electric vehicles, but at this point, still more than 90% of the vehicles being produced in the world are using petroleum products. Our estimate is that 20, 30 years from now, you're still going to be using petroleum products in perhaps a third, perhaps 50% of the vehicles being produced. We don't see electric vehicles completely replacing petroleum. Neither does the International Energy Agency or a lot of other people. The slow transition that we're seeing in energy technologies. So we do think that you're going to be using PGMs for a long time to come. And we do think that platinum will, at the right time, economically and politically, rise back above $1,000. But that's probably not going to happen this year, or probably not even next year. There is upward pressure, but there's a lot of metal out there. Palladium has come down too, partly because of the substitution into platinum, but for all of those economic and auto industry and investor attitudes that you saw that I just discussed in platinum, also affecting palladium. And so we are expecting palladium and platinum prices to be relatively mute for the rest of this year into next year. I think that's all I have. I have some housekeeping issues I want to talk about. We did issue our Platinum Group Metals Yearbook. It's about 245 pages this year. You can buy it as an ebook and download it on our website. And we had an hour-and-a-half briefing on the Platinum Group Metals on Tuesday to coincide with the release of our PGM Yearbook. You can see that on YouTube and say, gee, I really ought to get that book and read 245 pages as if I were still in college before I invest in platinum and palladium. It's a very good book. It's the source for accurate, unbiased supply, demand, price information, statistics, analysis. Other housekeeping factor, CPM Group will be going to the Silver Symposium in Spokane, Washington, 30th and 31st. That's where you can find out information about it, and you can go to Eventbrite and sign up. I think you might get a discount if you say CPM Group sent me. I'll be giving a speech on the real silver market. I will host an open forum luncheon period at which people can just ask us about anything, and we will either answer them and say, no, we're not going to answer that. And then we have on Tuesday, the 30th, an evening presentation, the evidence for and against silver market conspiracy theories. And I have arranged for Matthew Hunter to speak at the Silver Symposium and to join me on that Tuesday evening presentation. Matthew is the retired head of market supervision at the CFTC. And he did a remarkable job in renovating the market supervision in this department at the CFTC when he was there. And he is one of the brightest people I've known in the precious metals industry. And he's been in the commodities business. I met him, I think, in 1979, but he had already been there a long period of time before that. He's going to join me there, as is Bob Coleman. Bob runs a number of businesses related to precious metals investments and wealth management and wealth advisory services. And the three of us will be in this evening presentation. We will have open it up for questions and answers and a discussion. In preparing for this, I brought Bob and Matt together on a Zoom call this week, and they got to know each other, and they spoke for about 90 minutes about various issues that are germane to the silver industry and to investing in silver and to investing in commodities. So it should be a very interesting event. Now, I need to talk about one more thing, which is our criteria for debates. I've outlined them a few months ago, and there are various people who are out there saying, oh, Jeff Christian doesn't want to debate us. And we said, this is our criteria for debates. We will debate honest people, intelligent people, informed, knowledgeable people. We will debate ethical people who are transparent and professional. And I should add, we'll debate sane people. That's what we like. There are a lot of people out there who want to debate us, who have proven they're not honest, proven that they don't necessarily know what they're talking about, they're not informed, they don't have information, that they lack the ability to think critically, that they are maybe not as honest as some people would like them to be, and they're not particularly professional. Yeah, we had one group that asked us, starting last year, in the middle of last year, they wanted to interview us. And we said, well, you've said a lot of rude, stupid things about us and about the silver market. You've said a lot of things that were clearly not true about silver, and you probably knew they weren't true. So start with an apology, and then maybe we'll talk. And we did sit down with them and record an interview, and they decided that they didn't want to talk to us, or they didn't want to put that online. That was their choice. And we understand completely that a conversation between them, less informed, less intelligent, maybe less honest, I don't know, people and us wouldn't go their way. There are other people who have now come along and said, okay, I've been calling Jeff Christian a fool who doesn't know anything about silver for years. Okay, maybe he does know something about silver. They have no value to me or to CPM Group or to the world to engage in a debate or a discussion with people like that. If there are honest, intelligent, informed, ethical, professional people, I will gladly debate with them or have panel discussions with them. And that's the way we work, the way we've always worked. There are 1, 2, 3, 4, 5-hour discussions that have been had with such people. And we look forward to continuing to have that discussion on a global basis with people with whom it's worth talking. Sorry if I went on too long about that, but you know, one does get tired of that kind of trollish behavior. You can go to our website, cpmgroup.com, got all kinds of free reads, past videos. You can read about us. You can buy our yearbooks. You can buy other research and reports. And you can send us notes at info@cpmgroup.com about ways that we can help you invest or otherwise have exposure to precious metals and other commodities that are more effective, more efficient, more profitable perhaps, but at least better informed. Take care of yourself, take care of everybody else, take care of the world, and we'll see you next week.